If you're under the age of 40, you really haven't experienced much of a down market, whether it's real estate or in Wall Street.
No, people that age, they've grown up professionally in a false sense of security. They think that it does nothing but go up, that it's easy to just put money aside and watch it grow. And it's going to be a terrible calamity for them when the thing goes the other way. Because the market is going to go down at some point. We just don't know exactly when.
Yeah, I love your language. You're not saying if, you're saying when.
Oh, yeah, it's a definite. There's no question. Now we've got $34 trillion in debt as a country. Medicare is on life support. Social Security is headed towards bankruptcy. We've got some problems.
There's two ways for anyone to make money, right? Either you save money, you don't spend as much. So the government could save money by not spending as much. What do you think the odds of that happening are?
Have you, in your lifetime, have you ever seen the federal government cut a program?
No, exactly. And so the other way to do it for a business owner is to increase revenue or more sales. Well, how does the IRS increase revenue?
There's only one way. They get to tax you and me.
Increase taxation. What I find funny too is that when you get these politicians and socialites talking about taxing the rich, are they taxing the rich or are they taxing your ability to get rich?
Oh, it's more the ability. It's a disincentive. There's so many insidious taxes out there in addition to the federal income tax that it's crazy.
What's up, everybody? Welcome to another episode of Cash Flow Conversations. Today I have a good friend as a guest, Mr. Joe Still from Still Financial out of the thriving metropolis of Nacogdoches, Texas.
Hey, good pronunciation, Matt.
Thank you. I've never been there. It's not a very big town, is it?
No, we got about 32,000.
Isn't there a college there?
Stephen F. Austin State University.
State University. They have a football team, or what are they known for?
The Lumberjacks.
Nice.
Absolutely. In fact, their basketball team came within a whisker of making the Sweet 16 about 5 years ago.
Oh, wow. I think I remember you talking about that, actually. Joe, You and I have been friends for, 7 years now?
Yeah, probably about 7 or 8 years.
I love it. And so you focus in the financial world on business owners and with retirees. Not a huge stock market fan. And we had a little conversation before this started about the stock market. So this is going to be a fun conversation. Again, for everyone listening, this is not intended to be taken as financial advice or tax advice. This is just opinions. And before you make any decisions, consult a licensed professional. With that said, Joe, how long have you been in the financial world?
35 years this last October.
Wow. And how long have you been doing the one-on-one with clientele?
For the entire time, 35 years. I started in banking and did that for about a year after I got out of college and came into this industry because it was introduced to me. And the more I thought about it, the more I realized that it was one that would allow me to work with numbers and work with people both at the same time. And those are my two passions. So it was well suited for my personality.
I love it. And so we've worked together on a couple of different cases, helping people understand how to have more cash flow in retirement.
Mm-hmm.
And, I joke, if you're under the age of 40, you really haven't experienced much of a down market, whether it's real estate or in Wall Street.
No, people that age, they've grown up professionally in a false sense of security. They think that it does nothing but go up, that it's easy to just put money aside and watch it grow. And it's gonna be a terrible calamity for them when the thing goes the other way, because the market is going to go down at some point. We just don't know exactly when.
Yeah, I love your language. You're not saying if, you're saying when.
Oh yeah, it's a definite. There's no question. We've got $34 trillion in debt as a country. Medicare is on life support. Social Security is headed towards bankruptcy. We've got some problems.
There's two ways for the government to make money.
Beg your pardon?
There's two ways for anyone to make money, right? Either you save money, you don't spend as much. So the government could save money by not spending as much. What do you think the odds of that happening are?
Have you, in your lifetime, have you ever seen the federal government cut a program?
No, exactly. And so the other way to do it for a business owner is to increase revenue or more sales. Well, how does the IRS increase revenue?
There's only one way. They get to tax you and me.
Increase taxation. What I find funny too is that when you get these politicians and socialites talking about taxing the rich, are they taxing the rich or are they taxing your ability to get rich?
Oh, it's more the ability. It's a disincentive. There's so many insidious taxes out there, in addition to the federal income tax, that it's crazy. And when I work with people that are in that upper income or that upper net worth
Which would be
realm,
what's considered upper income?
in my line of work, I would say those who are making 250 or more.
Okay.
I think if you're looking at statistically, the top 5% of the country is going to be in the 170 range, roughly. And when I tell clients that, when I say, "Hey, you're making $200,000 a year, you're in the top 5% of the country," they look at me like I'm crazy. They don't think they're making near enough.
And that's the part that I always try and focus on too, is that if the government taxes your ability to get rich, if the language out there is tax the rich, they're not taxing the rich with wealth taxes. They're taxing your ability by taxing income tax. And so as these
Correct.
people are making 150, 200,000 a year, they're actually considered wealthy.
Correct. That's exactly right. And when you look at the U.S. federal income tax history, and you see what the top tax brackets have been historically, I'm talking about prior to 1988. It's scary because, a minute ago we talked about how the people who are 40 and under have only experienced upward trends in the market. Well, they've also grown accustomed to being in a tax bracket that is far lower than what history tells us the highest tax brackets were prior to 1988. And it's another factor that I have to teach my clients is it's not always the bracket, but it's the income that's determined to reach the bracket, because it's political suicide when you're ever running for office to say that we're going to raise income taxes. But what they don't ever talk about is changing the income that it takes to reach those higher tax brackets. And that is a very, very simple way for the government to get more money.
So there's a difference between a marginal tax bracket rate and your effective tax rate. And so,
One second, man. I'm sorry. Thank you. Sorry.
that's all right.
Problem being at home.
I hear you. And so when you look at marginal rates versus effective rates, that's what you're talking about essentially. So if the tax rate stays at 25%, anything above 100,000, let's say you get taxed at 25%. So political suicide, you're saying they're not going to raise the 25% rate. They're going to lower the threshold of which you hit that 25%.
Exactly. Lower the income it takes to reach that rate. I mean, today the highest marginal rate is 37%.
Yeah.
But people are never thinking about what their income is to reach that 37%, or what it takes to reach the 35 or 33 or whatever the brackets beneath that. And all it takes is very easily for the government to come in and say, we're gonna lower, instead of $600,000 to reach 37%, we're going to lower that down to $300,000. And that's going to capture all that additional income at 37%.
So this is really important for retirees, because people are looking at rate of return, like we said in the beginning. Under the age of 40, the market keeps going up, 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 up. Well, you're looking at a gross dollar value. They're not looking at the income that it can produce, because
Correct.
The higher the account value at distribution, if that's taxed as ordinary income, the government could take away all that growth just by changing the rates or the thresholds.
Exactly. And that's one of the things that we talk about when we're visiting with our clients. It's not as important how big of a pile of money you have as it is where that money sits and what types of taxes that money is going to create as you're taking distributions from it. People just they don't have any idea. They don't think about that if I'm married filing jointly and we have more than $44,000 of provisional income in retirement, that our Social Security, 85% of our Social Security is going to be taxed. I mean, when I talk to clients about that, they say, what are you talking about? Are you serious? My Social Security is going to get taxed? I said, well, yeah, if you've got more than $44,000 provisional income. And oh, by the way, half of your Social Security goes into that calculation.
I was going to say that. That's so funny. So I don't think anyone's even heard the term provisional income. It's only used to determine how much of your Social Security is taxable. And half of your Social Security goes towards the provisional income.
Exactly. Exactly. And then take a person who retires at 65 and maybe lives another 25 years. They can easily incur 10, 12, 14, maybe $15,000 worth of unnecessary taxes in retirement.
Each year.
Well, if they do that for 25 years, I mean, my gosh, Matt, think about it. That's $250,000 or more dollars they're just giving to the federal government.
Hundreds of thousands of dollars of unnecessary taxes because no one
Correct.
had a conversation of how to actually create income in retirement.
Correct. Because the traditional advisors only concentrate on helping their clients build a big pot of money. And again, I'm not against a big pot of money. I'm simply saying that where that big pot sits may have an adverse impact on your taxation in retirement. And that's something that advisors don't ever discuss. They don't ever talk about the distribution strategies. All it is accumulation strategies.
Well, why would that be? I mean, how does an advisor get paid? I was talking with another advisor about this and relating it to the medical world. There's not much money in curing ailments. There's a lot of money in treating them.
Mm-hmm.
And when you look at
same philosophy, great analogy, it's the same philosophy. Because you and I both know that what the average 401k advisor fee is 1% to 2%. I mean, so
and that's pre-tax. That's money that the government hasn't taken their fair share out of.
And if that's my bread and butter, I mean, my focus is going to be on let's help our clients build a big pot of money.
Yeah.
So
because the advisor gets paid on the pre-taxed amount.
Correct.
So if I had $1 million in an IRA or 401k, that the statement says $1 million. My joke is always, okay, we'll bring it to the office if it's your money,
right?
Which they can't.
How much that's yours, Mr. Client?
How much of that is yours? Exactly. Because if they were to take the $1 million out, 37, 20, 30, 25, 30% is going to go to the IRS or your state government. And you're going to net a much smaller number.
Yeah, just ballpark. You can say 600,000. That's going to be yours, especially depending on what state you live in.
Yeah, California gets worse. And so you have $1 million in an account. You go to take it out, you have much less. But the advisor doesn't charge on much less. They get paid fees on the full pre-taxed amount. So the industry is incentivized to gather pre-taxed assets.
Take it a step further. I mean, think about the government. How much of those fees, that 1% to 2% fee on that $1 million, is the government paying?
Yeah, none.
I mean, you redeem, you cash out that $1 million plan, you give $400,000 to the federal government, they walk away. You paid almost 2% on all of it, the whole $1 million. So the government loves your 401k.
Wow. You know, how many times have you talked to a retiree in their 60s going, I'm never going to spend this, never going to take it out? They have this account that they don't even enjoy anymore because they don't want to pay the taxes. The kids are gone. Those tax credits are no longer. The house is paid off. We don't get the mortgage deduction. You're retired, so you don't have business deductions. Your tax credits are shot. You're no longer contributing, so you don't get that postponement any longer. So every dollar coming out is taxed as ordinary income. And I've had dozens of conversations with people saying, I'm never going to take it out. And then my comment to that is, great, don't take it out. Look at your spouse. Turn and look to your spouse. When you're gone, Mr. Client, your spouse, they'll be left as a single taxpayer. And the condolence from the IRS is not in their favor. Because when you go from married filing jointly to single tax, those are two different tax brackets. You no longer have a spouse, and they could be in a higher tax bracket just because you're gone.
Right.
And then go one step further. Now, both of you don't take the money out. Now the money goes to your kids, and they change the law. And when the kids inherit that money, they have 10 years to pull all that money out. So I say, well, how successful are your kids? Oh, they're very successful. Well, are they making good money? Oh, they're making great income. Okay, so then the money that you're not going to take out to live on is going to go to your kids, and they're required over 10 years to pull the money out on top of their really good income. Tell me where the tax savings are.
Yeah.
We postpone the use of the money, invest in other people's businesses on Wall Street, and we don't have an exit strategy. So do you run clients through simulations when you talk about income planning?
Simulations.
So can you show someone like, here, based on what you have, here's what you can expect, and here's what, based on today's rates and everything, here's what you could expect to go to the government?
Absolutely. Here's what's going to be your withdrawal from your 401k. Here's going to be the federal income tax you're going to pay on that. Here's your Social Security. Oh, by the way, you're over that $44,000 provisional income mark. So now 85% of that amount of money is going to be subject to tax. Oh, let's take into account your Medicare premiums and what's going to happen to those because you have such provisional income. I mean, it just goes on and on.
Wow. So there's two major problems that exist for retirees, and there's probably there's more than that, but there's the two that we've talked about is the looming market collapse, and the second one is the unknown risk of future taxation. How can you hedge those two issues?
How can you hedge the market and the tax? Well, what we talk to clients about is trying to create tax-exempt wealth, okay? Wealth that is not going to be considered provisional income when you take it out. Wealth that you can, an account that you can grow that if you needed to, you could access it before age 59 and a half without any kind of penalties and taxes and problems that the government's going to hit you with should you decide to take that money out for a beach house purchase or a new car or helping your child go to college or whatever it may be. We talk about strategies where you're not going to be restricted by the federal government and do it in such a way that it's not going to be subject to market risk. Do it in an account that's guaranteed to grow every year, no matter what happens to the stock market. So when you talk to a client about, hey, there are ways that you can save money, that you can accumulate wealth that's not subject to market risk, it's guaranteed to grow every year, and it's accessible before 59 and a half or after 59 and a half without any taxation, suddenly they're going, really? Tell me more.
Wow. What's that called?
What's that called? Well, one of the best strategies is an overfunded limited paid life insurance contract. And you're going to say, life insurance? Why would you use life insurance? How does that work? I thought I just paid money into a contract and it's paid out when I died and my wife or my kids. So, well, that's death insurance. I'm talking about life insurance. I'm talking about the type of plan that does exactly what I just explained, one that you can use, one that you and your spouse can use. Tell me more.
Free from market volatility, free from taxation, and no red tape when it comes to access at any age.
Correct.
Now, you're not an advocate. I know this because I've known you for years. You're not an advocate of putting all of your eggs in one basket. But my goodness, why would someone not want a bucket that can hedge those risks?
Exactly.
And what's interesting is the tools that we use to build wealth very understandably could be different than the tools that we use to distribute the wealth.
Correct.
And the part that I found
about the disadvantages of the distributions upon death of a 401k.
Yeah.
I mean, you're talking about
on money.
It goes from here to here. But if they've got some assets that are in life insurance, the balance goes from here to here.
Yeah.
Upon death.
Yeah. Life insurance got such a bad rap in the late 90s or 80s and 90s. People could get a better rate of return elsewhere. So the idea of buy term insurance and invest the difference. And it worked for a minute, but you were in the business in 2001 and 2008. What was it like navigating those market crashes?
Well, it was interesting because, you get calls from clients and they're talking about, hey, the market, I just saw the market went down 30% this last quarter. Well, I need to talk to you about my balances in X, Y, and Z. Well, back then in 01 and 08, we did those types of plans. We did the 401ks, the IRAs, the market fluctuation products. And those are difficult conversations to have. Now, the other conversations and the ones that we've had since 2008, since we're no longer registered, we don't do that type of business anymore because now we understand how true wealth works. Those types of conversations were all wonderful. Joe, what happened to my account balance? I said, what, you talking about your life insurance policy? Yes. Is it gone down 30%? No, it's worth more today than it was yesterday.
Yeah, in fact, it went up.
You don't always do that.
Unbelievable. It's unbelievable how short-sighted some people can be when looking at the solutions. Just the name life insurance for the baby boomer generation, they have a bad taste in their mouth about how life insurance works. My age and younger, I feel like they don't because the narrative on the street isn't as bad about life insurance, I don't think. At least I haven't ran into it as much. But when it comes to distribution planning, I think life insurance is one of the most overlooked strategies. And if people knew how it actually worked, I think they'd be lining up to get some.
Oh, absolutely. Let me make two comments. I think one, as far as the negative perception of life insurance is concerned, I've always felt that the reason for that is the word insurance. And people think, okay, if I've got health insurance, I've got to go in the hospital for there to be a benefit. If I've got car insurance, I've got to have an accident for there to be a benefit. Well, life insurance, I've got to die in order for there to be a benefit. So there's a natural wall there that you've got to kind of get over and help client understand that you don't have to die in order for a life insurance policy to benefit. Now, when you talk about the advantages of distribution and how to use in wealth planning, when I talk to clients, and I know you know this, Matt, because you use it all the time with your clients as well. When you talk about the safe withdrawal rate, the uniform accepted safe withdrawal rate is 4%, which is the amount of an invested account that you should be able to comfortably take out every year, the percentage you should be able to take out every year to withstand the ebbs and flows of the stock market. Okay, and stand a 95 to 96% chance of not outliving your money.
Yeah.
Because retirees, when they come and sit down and talk to you, their number one fear is, am I going to outlive my money?
Yeah.
So that way of thinking, of course, prompted experts to determine that 4% was the safe withdrawal rate.
Yeah.
So a person's got $1 million balance, they can take out $40,000 per year. The reason that the safe withdrawal rate is so low is because it has to allow for those dips in the market. What if you've got a life insurance contract that's guaranteed to go up every year as part of your balanced wealth strategy? What does that do? Well, if I'm taking money out of my market-based investments in retirement, do I have to abide by that 4% rule anymore to protect against the downside? No, you've got the downside covered with the life insurance. So now instead of abiding by the 4% safe withdrawal rate, you can easily take out 7, 8, maybe 9% of that market-based investment. And when the market goes down every so often, then you use your life insurance. So it gives a client a much better standard of living in their retirement just by having that downside hedge in a life insurance contract. And once a client looks at that and says, wow, that really does help, then suddenly the light bulbs go off. And they say, hey, this is something that I really should have as part of my portfolio.
Yeah, I think you brought up a great point. That hedge is a way to increase income. So even if your invested account balance is a little less than what it could have been.
Correct.
By taking a portion and moving it to insurance, you can increase the income off of those two assets because you're not relying on the market to give you the returns. When the market goes down, you have the cash value and you can supplement your income that year from the life insurance and then allow the money to go back up in the market that we hope,
So to sit down with a client and say, look, you've heard of the safe withdrawal rate being 4%. What if we can devise a strategy where you can comfortably take out 8%? Really? You're going to double my income in retirement? Yeah, we can do that.
On a smaller account balance. That's the cool part.
Right. Well, and think about it. Most people have less saved for retirement than they hoped to have saved for retirement.
Yeah.
So making their retirement funds more efficient is key for clients when they're retiring.
And the way to fix that, they think, and I literally worked with a gentleman who was had $6 million in pre-tax money. Mm-hmm. Now he has $4 million. Because the market took it away. And after meeting and talking with him over these same strategies, his conclusion was he's going to chase the risk in the market to try and turn the 4 back into the 6. Now here's a 62-year-old that's never actually taken money out of his 401 and lived on it. He's living on income because he still works. And so there's a whole challenge there where people have to have this cognitive switch of, at some point, that asset is going to be triggering my income. And I don't think people even understand that. And so they combat it with more. What's that?
Another factor is he's still working.
He's still working.
And he's got that income coming in constantly. The goose is still laying the golden eggs for him. But when that goose goes away, now he's got a real concern at retirement.
Yeah.
And
it's funny because the conversation is
that's a problem.
And when we started the conversation, it was like, he goes, I don't want to lose money like that again. Okay, cool. I also don't want to avoid future taxes. Okay, all right. And then the solution that he chose to do didn't help either of those two things. He's going to stay in the market and chase that rate of return, which, if history proves true again, then he'll probably be in the same position. Which brings up another point. These financial products that you're discussing, they're not good or bad. There's pros and cons to each.
Correct.
And people have whenever someone throws an opinion about a product, it's like, well, either you got burned or something happened there in your past, because they shouldn't be viewed as a subjective thing. It's an objective thing. Like there's good side and bad side. And I used to joke back in the day that annuities are for poor people. Because I think it's a funny line. But the more that I've learned about annuities, holy smokes, what a great way to guarantee income for the rest of your life. You could live to 110 and you're still getting that check from an annuity.
Yeah, exactly. We're having more and more conversations with clients over the last couple of years about that very fact, because that's another great way to take away the market risk when they're in retirement.
Yeah.
They're worried about that 4% safe withdrawal rate. Well, a lot of those guaranteed income riders that you're talking about may equate to a 6 or 7% withdrawal rate, and there is no risk.
And there's no expiration. You can't run out.
Right. Just pay me and pay my wife for as long as we live. And if for some reason we die a little sooner than we expected, then whatever the account balance had left over is paid to our kids. So, because a lot of times you run into people who they may remember those annuities from years ago, and they think it's a life only. So you give this insurance company some money, and then they begin to pay you out. In the second month, you die, and they keep the rest.
Yeah.
I mean, nobody does annuities like that anymore. But those products do have a real fit for a lot of clients.
Yeah. So what I hear you saying is that the ideal position to be in once you start to consider retirement, and then this is something they should do before the day you retire, by the way. But
don't call us at age 65 and say, now we want to retire next month. We want to start funding an insurance contract.
Yeah. It's funny. It happens, man. People don't think about it. They just
it does. It happens every day. Yeah.
So, but the ideal position to be in is to have a little bit in each one of these. Dale Carnegie,
right.
Not Dale Carnegie, Vanderbilt, Cornelius Vanderbilt, and Elon Musk said it's okay to have all your eggs in one basket if you can control the basket.
Yeah, that's a big if.
It's a big if. And business owners can control that basket. Essentially, they have their own business. For retirees that are subject to market volatility, future tax, all these things, this is when diversification actually does make sense, in my opinion.
Correct.
So ideally, you would have a little bit in the market, and we call those play checks. You have a little bit in an annuity that is guaranteed income. That's your paycheck.
Paychecks.
And then you have your cash value life insurance. That's the hedge from the risky stuff in the market. So you have these three buckets. And here's the only thing we know about the future. It's going to be different than it is today. And one of those buckets will look better than the others. And it's the person with the options in retirement years that get to enjoy retirement.
That's exactly right.
I can't imagine being, all my eggs in a 401 and being fixated on the market, hoping the market goes up every single year when I'm 75 years old. I mean, I one of my favorite clients, I just genuinely care for this guy. He considers the high mark of the market his baseline. 2 years ago when it was up and now it's gone down, he wants to get back to his baseline. How's he going to do it? Chasing more risk. Now, we've set up some buckets for him to help offset that, but it's a sad position to be in, and one that I certainly don't want for my clients to, when they get to 70, to be glued to what's happening with Wall Street.
No, because I can't say that I'm like every person who's 70 years of age. I'm not there yet. But don't you think that most people who are in their 60s, 70s, 80s even, that they're more concerned with quality of life, spending time with grandkids, traveling, doing things like that, and stop worrying about whether or not my retirement account went up or down today.
Yeah.
That should be the last concern that a client has.
Yeah.
I mean, I don't want to live the end of my life like that. But that's me.
Do you get satisfaction when you drop your securities license and no longer played in the volatility market? How does that make you feel? Like what do you sleep better at night? Like what's
oh my gosh, yes. I mean, when you think about, for me personally, now, there are people that are in that business and they've done extremely well in it, and I applaud them. That's great for them. For me personally, the worries that you talk about, the all the issues that you've got to go through. But I was spending 30% of my work time on an area that was producing maybe 10% of our revenues. It just didn't make any sense for me. And so when I surrendered the registration,
Yeah.
it was kind of that feeling.
Yeah.
Now I can work in an area that I'm very comfortable in working. I don't have to worry when I go to bed tonight, are my clients going to have less money in their accounts tomorrow than they had today? I never have that concern ever again. And that is very, very comfortable for me.
Yeah, that's cool, man. Because not only you created that for yourself, you created that for your clients, right? I mean,
that's what we try to do.
I can't imagine.
It's a fun way to go to work every day.
I can't imagine getting paid to manage someone's money in the market that could go backwards, because they get paid even when the market goes down.
Mm-hmm.
That's like,
that 1-2% is going to keep rolling in no matter what.
And it's all about the exit. It's all about the distribution. So if taxes go up and the market fails, what we're talking about, life insurance and potentially even annuities, could literally rescue people from that.
Absolutely.
Can an annuity go down in value? Like, how does that work?
The only way an annuity is going to go down in value is if a person is taking withdrawals from it. So they put $1 million in an annuity and they take a 10% withdrawal year one. It's worth $900,000. They go to collect or go to surrender it, then there's going to be a matter there. They're not going to get the full $1 million, but they've already taken $100,000 out. Plus, most of the annuities are going to have some type of a surrender charge if you decided to surrender. But now we're getting down into the weeds. But what my clients are most concerned with is that balance going to go down tomorrow, next week, next month, next year? And you can say, no, it's not. Not in a guaranteed, not in a multi-year guaranteed annuity, not in a fixed indexed annuity. Those are always, the phrase that we use is zero is your hero.
Yeah, because if the market does -20, zero looks really good.
Market goes down 20%, your market-based investments have lost 20%, the annuity stayed here. Never did drop in value.
It's unbelievable.
Yeah. There's a lot of safety out there, and people just have to understand. They have to be educated. That's all.
And you've been working on some different ways to educate the public on their own right. You just created a new 5-part retirement series, didn't you?
Yeah, we've got a 5-part retirement series on how to retire tax-free, and it's been well received. The clients and the prospects, people that we've talked with thus far, it gives them an opportunity to learn more without having to sit down and be obligated to spend time with me. I mean, I know that sounds terrible for me to say, but maybe it's at 10:30 at night when they're at home. They've already put the kids to bed and they're about to go to bed themselves. Think, you know what? I got an extra 30 minutes. I can learn more about what Joe's talking about. Yeah. So I click on the link. There you go.
I love it. So for everybody listening, check out the description. We'll have a link to Joe's 5-part retirement series. It's free at this point, isn't it?
It's free. Yeah, we don't charge anything.
Yeah.
The education.
And this is based on seminars and things that you have done. And this type of information is the same stuff that a lot of advisors have the ability to charge to teach.
Right.
And
right.
You and I are in the same boat where I believe that transparency is going to be more and more prevalent in the years coming forward.
People expect it, and they deserve it. Yeah. People deserve transparency. You're exactly right.
Yeah. And the internet makes it so much easier. Someone can watch your entire course in their living room without having to go have a hamburger at a restaurant.
Yeah, watch the course at 10:30 at night. Think you like what you hear. Click on the next link, book a call. We'll talk for 15, 20 minutes a couple days later. Answer your questions. That's it.
I love it.
Very simple.
Very non-invasive.
No pressure at all.
Because you'll know if you can help someone right away, and then you show them what it would look like if they decide to engage. There's no fees, anything forward.
Oh yeah, we've had calls, Matt, where within 5 minutes you could tell real quickly they misunderstood what was in the video. They begin going down a path that doesn't relate to anything we're talking about. A lot of people look at multiple videos and they may book a call with me thinking that they're talking to someone else about another matter. Yeah. We determine it in 5 minutes and say, look, hey, this is what we're here to talk about. This is what our series was about. And they go, oh, okay, well, maybe that's not for me. It's not, but hey, enjoyed our conversation, got to know you a little bit, and 10 minutes, we're off.
Yeah. But if somebody wants to learn how to have guaranteed income, avoid future income tax, minimize exposure to volatility, that's essentially what the 5-part series is about.
That's exactly right. If you want to do those 3 things, this series makes sense. Look it over. If you like it, set a time. Let's talk for a few minutes and answer more questions for you.
I love it. Since we're talking about retirement, Joe, and then I'll let you go here because this has been a good conversation. But do you see yourself retiring?
I've had that question actually been asked a lot, and no, honestly, I don't. I think as long as God is blessing me with enough health to be able to do what I want to do, and that's work with people, work with numbers, solve problems, answer questions. I don't see any reason to retire. I really don't, because I love what I do.
I know. You're just helping.
I've got 3 children. One of these days, maybe one of those comes into the business with us, and that'd be a lot of fun.
Yeah.
Being able to teach and help and mentor. But no, I don't envision ever retiring.
If you were involved in the market still, do you think you'd have that same opinion?
I think if I was involved in the market, I would be on a lot of medications, and I'd be looking for a quick exit as soon as possible. Yeah, I retired yesterday.
I love it. I love it. Well, thanks for everything that you do, Joe. I think you're really setting clients up for success without taking all the unnecessary risk.
Well, thank you, Matt. I've enjoyed the time.
All right, brother. Good catching up. And then for everybody listening, check out the description. We'll have links for Joe's free 5-part retirement series. Joe, thank you so much for being here, brother.
Thank you, Matt. Have a good day.
Bye.